There are different types of taxes in the stock markets, my dear friends, like GST, Securities Transaction Tax known as STT, Stamp Duty, and Income Tax, which is the most important. So GST, STT, and Stamp Duty are all indirect taxes which is levied when you buy and sell shares in the stock market. Like how when you go to a restaurant, on that GST is charged. Similarly, in stock markets, when you buy shares of a company, say 50 quantities of 100 rupees share each, so total investment is 5,000, and on this there will be some brokerage, and after that GST, STT, and stamp duty will be charged. So total amount which you will be paying will be around 5,025 rupees or 5,030 rupees. So this is the concept of indirect taxes. Now let us come to the income tax, which is the most important. And income tax is applicable only when you sell the shares at a profit. Example, you bought shares for 100 rupees and you sold for 150 rupees. So that 50 rupees profit which you got, on that you will have to pay some tax. Okay. And now this income tax is classified into two: short-term capital gains tax and long-term capital gains tax. Short-term capital gains tax is applicable when you buy the shares and sell within a period of 1 year from the date of purchase, and the rate of taxation is 15%. Example, you bought shares of one company today worth 50,000, and after 9 months, okay, within less than a year, you sold it for 1 lakh. The share price increased and you sold it for 1 lakh. So on 50,000 rupees, you'll have to pay short-term capital gains tax at the rate of 15%, which will be 7,500. Then we have the long-term capital gains tax, which is applicable when you sell the shares after 1 year from the date of purchase. Okay, and the rate of tax is 10%, that too only in excess of 1 lakh rupees only the tax will be charged. For example, you bought the shares of one company today for 50,000 rupees. Totally 50,000 rupees you invested. And after 2 years, okay, that is after 1 year, more than 1 year, that is after the end of 2 years, the value of those shares became 2 lakh rupees and you sold those shares for 2 lakh. So what is the profit you made? 1,50,000 rupees. Now on this 1,50,000 rupees, up to 1 lakh rupees of profit is exempt. The balance portion, 50,000, on that tax percentage is to be charged at the rate of 10%. So 50,000 into 10% will be 5,000 rupees, which you will have to pay to the income tax department. Now understand that you don't have to pay this tax immediately when you sell the shares. You will have to pay this tax to the income tax department before you file your income tax returns, that is in the month of July if you are retail and individual investors. So I hope you now understand what is a short-term capital gain and long-term capital gains taxation. There is one more tax, which is tax deducted at source, TDS, on the dividends paid by the companies. If the dividend paid by one company in one financial year is more than 5,000 rupees to one particular shareholder, then TDS will be applicable at the rate of 10%. Example, suppose you got dividend from one company for 4,000 rupees in one financial year. Now since it is less than 5,000, there is no tax TDS applicable on this transaction. You will get entire 4,000 rupees in your bank account. Second case, the company has paid dividend in one financial year to you, totally 5,000 rupees. Again, since it is not more than 5,000, no TDS will be applicable. You will get 5,000 rupees in your bank account. Third case, the company has paid 6,000 rupees dividend to you in one financial year, then TDS will be applicable at the rate of 10% on 6,000, which will be 600, and you will get 5,400 rupees in your bank account as a dividend. So I hope now you understand what are all the taxes which are applicable in a stock market. Thank you.